Hello everyone, my name is Radovan Vojtko, I'm CEO and the head of research at Quantpedia. What would be the topic of today's episode? We will discuss the leverage ETFs. Leverage ETFs are very popular. There is a lot of talk about how to use those leverage ETFs in long-only investment portfolios. There are a lot of the articles that are trying to sell idea that if you use leverage ETFs, you can gain better performance without any higher risk, etc. etc. I tend to disagree. In my opinion, and I will show you the data that we have for the leverage ETFs. It may be possible to use leverage ETFs in asset allocation, but you must be very careful, and it's not possible without the active rebalancing and active allocation. So just holding the passive ETFs doesn't make sense. Okay, so this is like wrap up of the current episode, but let's take a look on the data.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
Okay, so firstly, we found the data. So our investment universe spans from 1926 until 2025, so 100 years. And it includes monthly data for both the leveraged and non-leveraged versions of four main asset classes. So what are those four main asset classes? US equities, 10-year treasuries, which are government bond, gold and commodities, and plus the fifth asset class, which is the cash. So we are using also the cash if we need in our asset allocation. Okay, so we identified the data. Those are all total return data for non-leveraged ETFs and their proxies, proxied by indexes. And then we created the leverage proxy. So we took daily performance of non-leveraged part, we leveraged it daily, calculated what is the price of the leverage, calculated what is the price of the ETF. I mean, remove the price of the management fee, remove the price of the leverage from the performance, and we created leveraged assets, and we checked what is the performance of those assets over 100 years. And here are the results. Here we have a table with the performance and risk characteristics of each asset class ETF without the leverage, and here we have the leveraged ETF. So what we can see, firstly, the gold. In reality, when you have the double leverage gold ETF, your performance decreased, your volatility increased, your drawdown significantly increased, Sharpe ratio is significantly worse. Okay, 10-year treasuries. So performance is the same, volatility is twice higher, drawdown is over twice the higher, and Sharpe ratio and calm ratio is significantly lower. Commodities. Okay, you have a performance about 0.8% higher. You have more than double the volatility, and drawdown, which is, I know, significantly higher. Once again, Sharpe ratio is lower, calm ratio is lower. The only asset class in which, when you use the leverage, or I mean, when you use the daily leverage ETF and has a higher performance, is the US equities, but you will gain only about 4% outperformance against non-leveraged ETF. But on the other hand, what will you pay? You have twice the volatility and the drawdown, which is minus 98%. So I mean, absolutely crazy drawdown. So Sharpe ratio is significantly lower than just holding the SPI or holding an ordinary ETF. Okay, so here we have the results on the charts. So here you can see, yeah, when you have the leverage ETF, you outperform the market with significantly higher risk. When you have the leverage commodities, your performance is nearly the same as the performance of the market. With the bonds is the same, and with the gold you are actually underperforming the market. I mean, just the holding leverage gold. Here we have a question. So if you have the constructed portfolio, the classical 60-40, which consists of equity and bonds, and we would like to replace part of the equities with the leverage equities. So what does it mean is that we will save the cash and we can invest that cash into the bonds or gold or whatever instead of standard equities. And that's the reason. You have a portfolio and you can leverage the equity part of your portfolio. So it means that you can have less equities in the portfolio and you can use the cash and you can invest into gold and bond or something similar. And you hope that you will gain something from the diversification. So we tried it, sliced it multiple times from different angles. All of the results show that it doesn't make sense. I will give you just one example. So here we have, for example, the benchmark, the 25% stock portfolio, 65% bond and 10% gold portfolio, which is, I would say, not very risky portfolio. It's actually very conservative because you have just 25% in the stocks, a lot in the bonds and some gold. So it's very conservative portfolio. And what are the alternatives? Instead of holding the stocks, we can buy leveraged stocks, we can buy more gold, more bonds, or we can slice it differently. But in each case, the Sharpe ratio is lower, calm ratio is lower. The performance may be higher, but you pay that with a significantly higher risk, etc., etc. So it really doesn't make sense to hold leveraged equities passively in your portfolio because maybe you will gain something on return, like 0.5% or 1% or 2%. I mean, it really depends how big your position in leverage equities is. However, you really pay a lot in the term of the risk. Okay, so there is a question. So if it doesn't make sense to hold them passively, what if we employ them in active models? And yeah, that's a little better approach. So actually we tried two different types of the models. The first one is the moving average, 10-month moving average model from a Faber, from the well-known paper from 2007. So at the end of the month, if the price of an asset class is above its 10-month moving average, the strategy takes position in the asset class for the next month. Otherwise, we move it to cash. So we have a portfolio, we splice the portfolio into multiple assets, and then we use the trend following overlay on that. And the second is once again from the Faber paper, but in this case from the newer one from 2025. It's a 12-month high rule. So if the end of the month price is between 95 to 100 percentile of its 12-month high, the strategy once again takes position in the asset for the next month. Otherwise, it moves to cash. So we have two kinds of the trend following strategy. Let's try how it will look like if we employ those strategies. So firstly, we employed those trading strategies on non-leveraged ETFs and then on the leveraged ETFs. But how? So we took the signal from the non-leveraged ETF, and then when the signal told us, yeah, buy the underlying asset, we instead of buying the non-leveraged ETF, we bought the leveraged ETF, and we compared what are the results. What we can see, firstly, when you are using the leveraged ETFs with the active model, you actually have a better performance. You pay in the term of the risk, but not in the same way as holding the leveraged ETFs passively. So especially for leveraged equities and leveraged commodities, which are really trending and they are trending assets, it makes sense to try to use a leveraged ETF as investment vehicle when you do the timing. So when you buy those ETFs when the trend is right. So I mean when the trend is positive. Whether it's based on the 10-month moving average or how close we are to 12-month high. Okay, so then we try to mix those ETFs into portfolio. I will skip through some of the tables. If you are interested, you can go deeper into the research and you can read the whole article. Here is the result. So once again, we took the passive portfolio, 25% stocks, 65% bonds, 10% gold, and we changed that allocation to 8% stocks, 65% bond, 10% gold, and 17% leveraged stocks. However, we took this portfolio and we tried to, instead of using just normal non-leveraged ETFs, we employed the trend following rule and used the leverage ETF with the trend following rules, and also all other ETFs with the trend following rule. And what was the result? We were able to find the portfolios that outperform the benchmark. The best case is the portfolio 4. So instead of using 60 stocks and 40 bonds, we can remain the position in the bonds, we can add some gold, and we can use the stocks and leverage stocks in a portfolio. And all of those assets can be timed using the either 10-month moving average or using the 12-month high, or how close are we to 10-month high. What is the result is that when we build those portfolios in this way and we use the active overlay, we are actually able to outperform the underlying market. We are able to outperform the benchmark, the 60-40, without the lower risk and have a higher performance. So what is the result of the whole analysis? Yeah, it makes sense to use leverage ETFs if you use them in your portfolio in active fashion. So if you have the active overlay and you would like to boost your return, yeah, you can use the leverage ETFs. However, if you like to boost the return and just use the leverage ETFs passively, I really do not recommend it. And if you are interested in the exact trading rules and the whole methodology and all of the tests that we've done, feel free to go through our article. You will learn a lot, and there are also the links to the underlying research. Here are the research papers, etc. So I hope that you liked this video. If you are interested in this kind of the models, the active models, the asset allocation models, etc., feel free to visit our webpage. Feel free to visit Quantpedia, go to the product page, and in the product page you can select. We have over 1,200 strategies and backtests and codes, and you can select the strategy that you like, from arbitrage to option trading to cryptocurrency, and you can even select the asset allocation, asset class picking strategies like I just described in the previous article. The easiest way is to go to keywords and select asset class picking, and you will get results. So we have over 60 or 70 strategies that are asset allocation strategies and very similar to the strategy that I just showed you. Thank you very much. I hope that you liked the video. Please give us a like, subscribe to our channel, subscribe to our newsletter, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.